Welcome back to Stock Spotlight. I'm your host, Michael. Today's episode is a little different. I'm joined by Blake, who I originally connected with through X, talking about individual stocks we liked. Blake still researches and owns individual stocks, both personally and for clients, but he's also been incorporating more all-weather and lower volatility portfolio construction into his work. That perspective is interesting because few managers consistently outperform the S&P 500. So the advisor role is not always about picking the next great stock. It can be about helping investors get the exposure they want with less hubris, less concentration risk, and a portfolio they can actually stick with. And I thought this was the perfect time to have this conversation because diversification is suddenly interesting again. For the last decade, it often felt like the answer was simple: own US equities, especially mega cap growth, and don't overthink it. But now we are in a different environment. Gold has been strong. International markets are starting to work again. Bonds have behaved differently than many investors expected, and managed futures and alternative strategies are becoming more mainstream with retail investors. So the big question for today is simple: how do you build a portfolio you can actually stick with through good times and bad? We'll use ideas like Ray Dalio's all weather framework as a starting point. And since this is Blake's first time on the podcast, we'll also talk about his transition toward portfolio management, how his thinking around risk has evolved, and of course, our shared appreciation for the California and Hawaii lifestyle. Now, enjoy the show. Blake, welcome to the show. For listeners who may not know you yet, can you give a quick background on who you are and how you got interested in investing?
Yeah, sure. Thanks, Michael. Happy to be here, by the way. So thanks for inviting me on. I've been saving money since I was in elementary school. So at all times, and especially eventually, as that piggy bank grew, I needed to figure out where to put my money. I discovered my mom's 401k, which was both tiny and mismanaged in my early 20s, and that really inspired some self study. We had, grown up really humbly. She was a single mom and, worked really hard to, keep everything going. Right. So kind of learning that things weren't managed very well there was a really frustrating and impactful experience for me. So for most of the last decade since then, I've self-taught myself markets, business analysis, and thankfully had a lot of help from authors, other investors, and resources like X as well. I was also formally studying. I studied accounting and finance and was fortunate enough to get a start to my career at KPMG. I then moved into due diligence for mergers and acquisitions, and then finally into corporate finance. That whole time, or at least for about 6 years now, I was helping family and friends invest. I was really averse to doing it full time or becoming a advisor formally because the experiences I'd had with them were so negative. And I think the industry in general is mostly sales and marketing. It's There's not a lot of financial experts there. So for a long time, I wasn't interested in doing it. But last year, kind of enough evidence and experience was weighing on me that, okay, I should do this formally. So I, finally registered as an independent RIA, and it's been really great. I feel really excited and, I get a lot of joy out of helping people invest and manage their money as best we can.
I think that's great, and I have plenty of friends who the biggest hurdle with them is just getting them to take money out of cash and even uh, moving it beyond to high yield savings into real investing, whether in index funds or ETFs or stocks. And I love the self taught part that you mentioned too. I studied business in college, but I think as we get older as investors, that's really the best way to learn is to learn through experience and just putting money into the markets. Now, we first connected on X, talking about individual stocks, but lately it seems like both of our thinking has shifted toward the bigger picture of portfolio management and construction. What sparked that change for you?
So I still spend a decent amount of time studying businesses, which is just fascinating and interesting, right? I think to some degree we all, of course, love making money, but we also kind of love the process, right? You get to learn a lot about the world, the economy, and just what's going on. My portfolio as well, right? I also own a lot of individual companies still, but getting to like portfolio management and diversification, it kind of happened by accident. Managing other people's money, I just felt an innate need to really understand financial history and financial assets broadly. So that led me and continues to lead me down different roads of study for assets like gold and bonds and international equities and currencies, right? And that's not all. There's still more to learn for sure. And so that ended up coming in handy because I work with people who might not be in their 20s and 30s with a high risk tolerance. Or you could take my mom's IRA, right? She probably shouldn't be investing the same way as me. We don't have the same time horizon and risk tolerance by definition because she's going to need to draw on those funds within 10 years, right? So all that kind of self study and research has lent itself well to managing money for people closer to retirement and with different risk tolerance. Um, and it's also helped, I think, get people out of cash. As you were just mentioning, you have friends who are kind of in that boat of they just have their money in a high yield savings account or worse, right? A lot of people have it in a checking account or a business checking account, not earning anything. And as safe as that feels, they're losing wealth every month and every year. So plenty of those people that I've worked with who came from that situation or are still in that situation, they're not comfortable buying the S&P or letting me pick stocks for them, and that might be entirely appropriate. But a few of them so far have been comfortable moving into a portfolio of diverse assets, equities, bonds, and gold at least, which allows them to have an expected return of, let's say anywhere from 5 to 9%, which has a real return as well that will beat inflation, but a lot less volatility than owning the S&P would have. So it's inevitable that they'll probably underperform in the long run, but they're vastly outperforming where they were when we started in a checking account or savings account.
Yeah, it's definitely a process. And you and I both have roots in California and Hawaii, and they say that your environment shapes how you think. What do you think it is about that world that resonates with you? And do you ever find it shaping the way you approach investing?
Yeah, that's a good question. There's definitely a lot more wealth here in Honolulu than in Sacramento. And, perhaps some of that is neighborhood too, right? I'm sure there's wealthy people in Sacramento, just maybe not where I grew up. And now here in Honolulu, it's everywhere. So it's inspiring and, you know, also just always pressing on my mind. You're wondering, how did people make their wealth? What are they doing with it now? Right. And that's something that I think is interesting. Um, More importantly, probably if I'm honest, is I think I experienced a lot of financial insecurity for most of my life. We never really had any money as a kid, and that was kind of a constant constraint on on all of us. So the natural carryover is that I was always looking for bargains in the stock market, and that can be good and that can be bad. I really like to quote Ben Graham here, actually, who of course is heralded as being the kind of value stock king, right? And um, he actually has a really interesting quote though, because he says that paying too high of a price for a good company is not the chief risk of investing, right? So overpaying, paying a high multiple is actually not the chief risk. The chief risk of investing is paying a low multiple for a bad company. And so that's a lesson that I think most value investors have had to learn the hard way, that I think I've learned myself as well. And thankfully, I've never blown up an account or really taken a huge loss on a position, but I definitely could have, right? I've, unfortunately played with fire before in my own account. And so, through those experiences, my philosophy has shifted to, finding the best businesses which can sustain competitive advantages for decades, right? At least with the highest probability of doing that. And so, given my background and my formal, training, both in accounting and finance, doing M&A, I'm still very price sensitive. I refuse to pay, you know, incredible multiples for even a great company. So my portfolio approach is generally trying to optimize that confluence of durability, growth, and value instead of just value, which is probably where I would have started 6 or 7 years ago, looking for low PEs. So how about yourself?
Yeah, no, it's eerily similar path that you've had where, especially I think going through business school, and even at the grad level, teaching you DCFs and all these different ways to do things. And I think that naturally leads towards value investing initially. But I learned the hard way. I think one of the first companies I invested in was UPS, and they got hammered after I invested in them. It was like a value at the time, but they ended up becoming a value trap. And I started thinking about quality more, and business models, and it naturally kind of went over to quality growth. But then I love that we were talking about portfolio construction too, because then it's just beyond that. It's how do you add bonds and gold and all that too. So what's interesting is that for most of the last decade, it feels like diversification almost felt like a penalty while US mega cap growth dominated everything. But now in 2026, we're seeing things like gold, international equities, commodities, and some alternatives finally start outperforming again. What do you think is actually driving this shift in market leadership?
Yeah, that's a good question. I think, speaking, to valuation, right, and kind of have a value investing bias, foreign markets started at heavy discounts. So, to me, they kind of had that, that room to run, you could say. And foreign central banks have been more aggressive in cutting rates. You also have the dollar down about 10% in 2025. And, we saw inflation and growth return to Japan. And, that market had a really big year. So I think those are some of the big factors. In international markets, you also have a lot more commodities, you know, concentrated into those, equity indexes versus the US, which is mostly IT and asset light businesses. And so the commodity inflation, makes its way into those stocks. And then, of course, you just have some really outlandish outliers, right? Like Samsung and SK Hynix. I don't know what if they returned 5 or 10x each this year. And then, really big companies like TSMC and ASML, maybe they've doubled, right? Or a little more than doubled over the last year, but they have such a big weighting in those indexes that they've pulled the, international indexes up.
Yeah, and ASML has jumped up to like my top position just in the last year, and it's interesting seeing that, and then some other ones just with no return. It's been a very interesting market the last few months and year.
Don't rub it in on ASML. I bought it in when did I buy it? I bought it in 2025 sometime. It was, floundering around 6 or 700 bucks. And it was a solid position for me, thankfully. I think I made it a 5% position, but I think I sold it before it doubled around 1100 or 1150. And ever since then, it's just continued to appreciate. So, I think that's maybe well, you could tell me my kind of biggest mistake usually is selling too early, right? You hear that from a lot of value investors, even though I try not to think of myself as one anymore. Do you experience the same thing, or are you better at that?
I would say for me the biggest thing is it's actually interesting. You mentioned the quote is I love businesses, and so for me it's like which is why I'm doing my own after this episode kind of portfolio analysis of buying too many stocks that I like and maybe paying a high multiple for quality companies. And that, that's definitely with ASML, it was interesting because my dad and I were buying it together at the same time. But the sentiment was kind of negative at the time around it. And if you just looked at some of the numbers, things looked pretty good from a valuation, and, the company's moat and everything seemed to be doing well. I just think no one really could have predicted, like Micron and some of these companies that just went haywire in the last year. And but then like I own Nintendo, and that's been a up and down, and they're now considering, I'm considering them if I simplify the portfolio to maybe exclude them or something. But yeah, I think it'll probably come back down. It won't be my top position in 6 months from now, but for me, I guess I'll continue to hold, and we'll kind of see how things go with that. Now, the classic all weather portfolio, we've talked about this a little bit, sits at around 30% stocks, 40% bonds, specifically long term bonds, 15% intermediate bonds, 7.5% gold, and 7.5% commodities. And this was Ray Dalio's initial framework, with the idea behind it being risk parity, in that you can spread risk across different economic environments. So something in the portfolio is always working. Do you think that original framework, though, still works in today's environment?
You know, I guess the answer is mostly yes, right? I mean, like if we look at there's a all weather ETF that State Street manages based on Dalio and Bridgewater's approach. It is positive, right, since inception, and I think it's even probably up 4 or 5% this year. Um, of course, it probably had a really bad 2022, but yeah, to some degree, it definitely still works. It probably doesn't work as well as it did from what 1980 to 2021. And if you're asking for my sentiment on it, I don't like it, right? I do not like owning long-term treasuries. It seems like a really high price and a really large risk to pay for at least the perception or thought of diversity and less volatility. Bonds have this perception of being incredibly safe and reliable and predictable, let's say, right? But at the end of the day, they are just pieces of paper. Like US dollars are just pieces of paper that are printed at the Fed, right? So, well, they can be printed, and if they print more, they become worth a lot less. And all fiat currencies to date have lost almost all of their purchasing power against gold, right? And many more before them have failed. Even non-fiat currencies have, failed in the past, right? They were debased with less silver, less gold over time, right? Anytime you have a government or some human authority dictating the value of a money, that's probably not the best formula for long term value, right? So if Congress wants to blow out the deficits or the Fed doubles the money supply, you're just shit out of luck, right? And we're very lucky this hasn't happened in our lifetime or our parents' lifetime, but it has happened many, many times in history, and it probably will happen eventually. So I'm very averse to that kind of exposure to long duration. And with my clients, I have a lot more of a bias towards short and intermediate duration treasuries. I could probably go on this. This is a topic that I've thought a lot about and have stronger feelings on, but I'll let you jump in. Michael, what kind of do you think about that approach?
Yeah, too. When I look at the original framework, I agree. I think the long term bonds and the commodities is the two things that I would have some beef with. And I even got burned personally with, I own some VGLT, and my dad still makes fun of me. I think might have been my worst investment ever. I finally got out of it, but I did own some VGLT, over the last few years. It was basically during the time when it was really drawn down, and it's still, in a long, 5-year drawdown, I believe. But um, I think the thing with VGLT and the long term treasuries is that there is some long term evidence of it supporting a really equity driven portfolio. But from what I found practically, a VGIT and intermediate works just fine for most people. And we'll talk about it in a little bit, but commodities are questionable long term ad. And I've also found some interesting uses of managed futures in replacement of bonds as well, or in addition to bonds. So that actually will kind of get us into exactly what I want to talk about next, which is those traditional diversifiers. So think bonds, gold, commodities, and then international exposure. The standard 60/40 playbook assumes stocks and bonds would move in opposite directions. That when equity sold off, bonds would cushion the blow. And for a few decades, that did hold up. But if you look at the 1 year rolling correlation between stocks and bonds, it's been all over the place historically. And we've even seen it turn positive again in recent years, which sort of breaks that initial assumption. And credit spreads are relatively tight. And then right now, we're also sitting in a world where that real interest rate is essentially flat at zero. So my question for you on bonds is what role do you think bonds actually play in a portfolio? And can investors still rely on them the way that Dalio's framework assumed?
And at a high level, right, I think that they do play an important role of in diversifying risk and revenue stream or income stream, right? But do they still play the same role? I don't think so, right? Like, and most of I think that kind of like historical argument for bonds comes from a time period that really favored them, and we're probably not in that same regime anymore, right? Um, Speaking specifically to a 55% allocation, that's definitely high, but it can be entirely appropriate for certain investors, particularly retirees or those with really low risk tolerance. The key issue to me isn't the allocation itself, it's duration risk. So I don't think, an investor can rely on government bonds for the next 50 or 100 years and maybe not the next 30 or 40. You really don't ever know when, something major is going to change with our monetary or financial policies. Um, for decades, right? Speaking to, history, long-term treasuries were viewed as the ideal for portfolio ballast because they tended to perform exceptionally well during equity bear markets, like 2008, for instance. But 2022 demonstrated this relationship is not guaranteed. Long duration treasuries, as you mentioned earlier, suffered about 50% drawdowns, which they're still in. And I think it's been a good reminder that they hedge deflationary shocks, not inflationary ones. And, as we kind of examine what we're dealing with today as investors, it seems like we certainly have more inflationary risk than deflationary risk, right? For all the talk about doomsday AI scenarios where unemployment rages, we don't see any evidence of that so far. All we see is CPI tracking up. Even software engineer postings for jobs, right, are higher and higher. And productivity by like, I think all economic estimates is set to rise, right? So we also have nearshoring and reshoring, which is naturally inflationary. It's going to cost more to make stuff here in the US than it did in China or, Indonesia, right? So to me, the risks are kind of skewed toward inflation. And that means that long term treasuries are not going to perform if, that plays out. Now, there's always a risk that we're wrong, right? And that's kind of how, in part, I've come to terms with having some exposure to long term duration in certain client portfolios. I might think I'm right. I might think the risks to inflation are much higher. But you know what? The rest of the portfolio is slated to benefit in that scenario. All the equities, all the gold will do well, right? And there's a material risk that one, your advisor, if you're my client, it's me, right? There's a risk I'm wrong, right? And so part of my job is to make sure that you'll, have a good return even in that scenario. Or if we do have a, you know, unemployment driven recession or some other catastrophe, right? It could be plague related, as COVID reminds us. It could be, wars, like a much bigger war than this Iran war. So you just never know what's going to happen. And, trying to create a positive return in all environments is, I think atop of a lot of investors' minds. So, anyways, getting back to bonds, I just have very little confidence that government bonds will reliably preserve purchasing power over long periods.
Speaking of gold, I used to think of it mostly as an inflation hedge, but the data seems to push back on that. And that what it does tend to do is perform well when real rates are low or negative, which makes sense as gold has no yield. So when real yields are near zero, the opportunity cost of holding it does disappear. It also diversifies during certain stress environments, though not all of them. What are your thoughts on gold?
Yeah, I like the way you put it because, something I kind of discovered, right, as I um, went to learn about gold a couple of years ago is that relationship you just described with real yields. Which, speaking of which, kind of broke a year or two ago, or I think actually a little earlier than that, maybe 3 years ago. And perhaps it had to do with the sanctions we made on Russia. Um, but that's been interesting because for I think at least 10 or 20 years, there was a pretty good tracking of gold and real yields. And it just completely left that track in 2022 or 2023. So that's been interesting to see. And I would say I think of gold. You mentioned it possibly being an inflation hedge. I would say that I do think of it as an inflation hedge, but to bring in what you shared regarding real yields, I think real yields kind of guide it right along that path. Like the higher real yields are, then that's a bit of a headwind to gold, and the lower they are, then the more attractive it looks, right? And then in the long run, I think they generally do protect against inflation. Um, Speaking to gold, one thing I'd flag to listeners is we see a lot of gold charts that conveniently start in 1971. You might not have noticed this before, but I think hearing this, you'll notice it now. All kinds of gold bugs and people who want to promote gold and show how great of an investment it's been compared to the S&P or something else. Their charts always start in 1971 before it 20x'd. And what they don't tell you, and they might not even know, is that this is because gold was held underwater for about 70 years before that. The Gold Standard Act of 1900 set the price of gold at $20. Right? This was government regulation that the price of gold was 20 bucks. During most of this time, it was illegal to own it. And so the price of gold was not, like openly traded on the market. And it stayed there until the Gold Reserve Act in 1934 raised it to $35, right? So that didn't change until the end of Bretton Woods in 1971. And so what we have there in total from 1900 to 1971 is a price of gold that had started at 20 bucks and ended at $35. So it appreciated 75% over 71 years. But meanwhile, the purchasing power of a dollar had fallen 80%. So what that means is that just to keep up with the debasement of USD over that period, gold should have 5x'd, right? It should have increased from, let's say, if it truly deserved to be at $20 in 1900, if that had been the market price, then around 1971 it should have been somewhere in the ballpark of $100 because the purchasing power of USD had fallen 80%. So when Bretton Woods ends and this Gold Reserve Act comes to a close, right? It was entirely expected, or it should have been, that the price of gold would rocket. And so that's exactly what happened during the 70s. And so, you know, that catching up was valid, but to start a chart in 1971 and suggest that the returns of the 70 was anywhere near normal, or that to include that in a historical CAGR that should be expected going forward is pretty naive and misleading. Um, to a lesser degree, you'll see 2000, the current gold charts going around. That's another kind of convenient starting point. What you won't see is a chart that starts in 1980, right? And this genuinely can be challenging, right? Like, when should you, like, how should you analyze gold, right? Like, that's a good question, and I don't have the perfect answer, but you probably shouldn't pick like the ideal starting point that makes it look as good as possible. So, and I say that as someone who really appreciates gold and had a pretty big position, in it over the last couple of years. Speaking to returns and what gold does, I generally do think it should maintain purchasing power, right? So that might look like 4, 5, 6, 7% based on inflation historically. I think that would change if inflation changed, right? So if we started to get no inflation, or God behold, 10, 20% inflation, I think then gold would, in the long run, match that. So I think the return of gold is, going to match purchasing power and, the value of money to a degree. And you won't get it in a straight line. It seems like gold is typically flat for something like a decade or two. And then there are sharp and rapid revaluations. My clients who do own gold, um, we usually have that allocation around 5 or 10% max. And, as far as today, I wouldn't be a heavy buyer of it. I was a couple years ago when, by my analysis, it was cheap against M2. And I don't think that's the case anymore. So, in that sense, my analysis was right, but the timing was very lucky. So I wouldn't be, looking at gold for a short term trade here or, anything other than just a long term diversifier to a portfolio.
Yeah, I totally agree on the long-term diversifier, and similar when I was thinking about my portfolio too, I bought gold and it's been one of my or the I bought the GLDM ETF and it's been up quite a lot. But to your point, it's the timing with it, and you have to think about it on a long-term perspective. I'm definitely not anticipating those returns moving forward.
Yeah, why did you buy gold? Was that, to, balance out your portfolio and it happened to be good timing, or how did you make that decision?
Exactly right. Yeah, I was going through kind of a portfolio analysis, and I had looked into long term bonds, and VGLT hadn't been working out. I'd been looking into managed futures, and I liked gold's low correlation as well to the S&P. And for me, it was kind of deciding between different ETF products. Like there's a GLD, and then there's a GLDM, and there's some different nuances between the two. But one of the great things I think about today's world is that there's just so many different options for different exposures that you're looking for. I even recommend to people, we have it too in our family, just owning physical gold as well and having that somewhere in a safe place. The next thing I want to talk about is commodities. And this is where the 5 year charts get really uneven. You have gold, up 150% or so, silver up even more, and copper has been up 35%. Brent crude's been up 50, 60%. Palladium, though, has been down, and natural gas has been essentially flat over 5 years, despite a massive spike in 2022. So commodities as a category can be really misleading. And then the stock to commodity correlation that I look at swings wildly over time, which makes sizing them tricky. Which then raises a question that I've been sitting on. I've seen some portfolio researchers, including the folks at Optimized Portfolio, swap out the commodity sleeve entirely when running back tests and replacing it with some utility exposure like FUTY, which is the Fidelity MSCI Utilities ETF, and some of these back tests look compelling. What's your instinct on that kind of substitution, and how do you view raw commodity exposure?
So I really like the substitution because I don't really like raw commodity exposure, right? I think as two guys who have prioritized quality and durability in the businesses we want to own, right? Um, it should probably strike us immediately that commodities are generally exactly what we want to avoid, right? Because there's no pricing power, there's no real differentiator. How do you maintain margin, right? If you're selling a commodity. And so, you know, that doesn't necessarily mean that investing in commodities would be bad, but historically it has been, right? There have not been long-term returns owning commodities. So for that reason, I love the switch, even though I don't really love owning utilities. The capex requirements of the business kind of turned me off. It seems to be, dependent on never ending, new capital, and the actual distributions to shareholders are quite small. Um, so I can totally grasp that they perform well and they probably will continue to perform well. But when I consider how would this perform if I owned the whole thing, right? If I owned the commodity or the whole commodity ETF, what would be required of me is that I continually fund these, this new capex, right, or raise debt to fund it. I would receive, maybe a small dividend. I think it's lower than 3%. That's it, right? And like, there's no repurchasing of stocks. You can't sell the assets because you're regulated. You don't have pricing power. You might get your prices raised, your ability to charge higher prices raised, right, if you can demonstrate your costs increased. But I don't really love the businesses. Their revenue is insulated from economic volatility, right, because people have to have power. That's probably the best thing you could say about it. So again, that's still a lot better than commodities. And I think they have lower beta, right? So they probably smooth out the returns for a portfolio.
And then there's international, which has been a graveyard for over a decade. US outperformance just kept steamrolling every valuation argument. But in 2025, international developed markets had their strongest performance versus the US market since the 1990s, with an ETF in my portfolio, IMOM, returning 47%, which Alpha Architect wrote in their paper, Momentum in Motion. Do you think we're at the beginning of a sentiment shift towards international markets? And how do you think about building the international sleeve of a portfolio?
Speaking to a shift, it's definitely possible given some of the kind of geopolitical, you know, dynamics, right? You see, nearshoring and reshoring production out of China. And there seems to be a bit of, realignment going on, right? I don't follow it like the most closest, but it seems like, the current administration in the US are not, maybe quite as friendly with Europe. And, um, there's definitely kind of an ongoing, feud or whatever you want to call it with China, right? So maybe there is a kind of surge in a desire to own international equities. Whether that lasts or not, they'll definitely need earnings growth for that to be durable, right? And that just hasn't been the case for the last couple decades. As much as you might look at charts and see, okay, the U.S. has outperformed so much, maybe that's going to flip. Well, maybe it won't, right? We probably still have by far the best companies here. We're leading AI development as far as we can tell. So I don't know, right? If that will be lasting, speaking to the kind of international surge or not. When I look at it, it's not something super compelling to me. I think the most compelling things I find are like maybe Japanese stocks and small caps in Japan that seem to be both growing well at good valuations. Um, it's not somewhere I put my money, but other than that, I just don't see, I guess the thesis there. I wouldn't really want to put money in Europe. They don't seem to be very friendly to capital. And then China, right? You would think that's a great place to put capital. I mean, maybe you would, right? If you see, okay, Alibaba's at, such a low valuation and growing a lot. But the rules of law are not really friendly in China to, you know, private capital, right? So for me, that's a hard no. And I think a lot of international investors have that same, you know, perspective. So it's got to be pretty exceptional for that to change for me. Like ASML was a company I bought, so is TSMC. I actually still own NXP Semiconductor and LSEG, but even like LSEG, I probably want to sell and buy ICE, right? Which I think is a company you own, and it's probably just a better company. For aggressive clients that own individual stocks, in some of our portfolios, we have ASML and TSMC. Um, but for the majority of clients, we would just stick to an ETF. So, whether that's something like VXUS or an ETF like DBEF, which is kind of a broad based international equity fund that's hedged to the dollar, that kind of breaks the rule for a true all weather portfolio because, if you're hedged to the dollar, then you don't have any international currency exposure. But my bias is kind of that's probably better. I think of USD as the best house in a bad neighborhood of fiat currency. What do you think?
Yeah, so I have around, I think 10% of my portfolio in international between, and I think I categorize that between like AVDV, which is international developed small cap value, and then a Freedom, which is FRDM, which is an emerging market, excluding China exposure. And beyond that, though, I don't, ASML and a few other stocks that are non-US, but I don't get too much beyond that in terms of percentages. Like you said, I think even, some of the math will tell you more, 50-50 international and US, but for me, it's a little hard to go over 10%, but I definitely think some exposure to international equities is good, especially if you have like, me, where I started out in a S&P 500 index fund.
Great point, by the way. I think, like, I mean, you could probably hear my biases. Like, I find just better investments here in the US for myself. But, to this broader topic of portfolio construction and diversity, it absolutely is a good idea to have that international exposure, like you discussed. And if I was leaving money for my family for, some extended period of time, 30 or 50 years, right? Let alone longer, I would absolutely, have international equity exposure.
One area I want to briefly touch on is, you can maybe call it slightly more sophisticated diversifiers, although if you look under the hood, a lot of it is just trend following. But a topic called managed futures, and there's some different areas of managed futures, and we can get into. But what's interesting about them is when stocks and bonds both got crushed simultaneously in 2022, they actually had one of their best years. And so people started paying attention, and they did struggle for a few years after that. But now, again, in 2026, many of my managed future ETFs are actually outperforming my SWPPX. What do you think of managed futures in terms of maybe becoming a legitimate third portfolio bucket next to stocks and bonds? Or do you still think with most investors, they might be too difficult to understand and to hold through some of these flat periods?
Yeah, I would probably lean toward the latter. I generally think for people keeping it simple is ideal. Um, so I probably lean in that direction. But you could definitely add some knowledge here to my understanding, right? I haven't spent as much time studying these products. I did see that the CTA index, which tracks at least, or at least one of the funds you've mentioned, tracks the CTA index, and that index has gained about 4.5% annualized from 2000 to 2024. So, when I see that, I think, okay, that's a lot less than the S&P. It's more than long-term bonds, more than, I guess, any duration treasury, and it's probably a little lower than gold, um, but probably less volatile too. So yeah, it wouldn't surprise me if they can have a place on a portfolio, particularly if they are very uncorrelated to stocks and bonds, and it smooths out your overall returns. Um, but it is not something that I've included, and I'd really want to understand exactly what's going on in there, or I know, like, with my psychology, I won't be able to own it if I don't fully understand what's going on under the hood and believe that structurally it's going to add wealth, right? Like, without luck or some, like, advisor picking the right thing at the right time, then I will not hold it in the long run. So I just wouldn't touch it, right? And same with the client's portfolio. But yeah, if you have that knowledge and trust in it and can have faith that, okay, it's going to average about 5% and beat inflation, and it will also add diversity, then it sounds pretty great, right?
Yeah, there's some really interesting products out there, but to your point, it does seem to have a lot of the managed futures ETFs have negative correlation to the S&P 500, and with annualized returns that's seem to slightly beat bonds. So to your point, it kind of seems like that unicorn diversifier. And just for the audience, a few things around. So some of the products that I like, one is KMLM, and it's essentially just looking at moving averages across, and I think they look at across several different asset classes, but they do exclude equities, and that's partially what gives it that low correlation. There's other products like one called DBMF that looks at all kind of what the major hedge funds are doing and takes sort of an average of that. Um, so to your point, I really recommend listeners to they have fact sheets and different prospectuses, and download the PDF and read it through and take a look at what it actually is. But just I ran a simple test, and so I added KMLM, CTA, and DBMF to SPY in different combinations, and I just used the common live window where all the ETFs overlap. So this was from I think 2022 in April to May of 2026. And the results using, I think I just used a 4.2% risk free rate, were pretty interesting, where SPY did have the highest standalone return in this short window. But if you added managed futures, it did materially reduce volatility, drawdowns, and equity beta. And actually, the best mix was a 75-25 and an improved Sharp from about 0.62 for SPY alone to about 0.84. Um, so I do think managed futures are becoming a potential legitimate third bucket. But especially, and you mentioned with some of your clients, and for me, it's with my dad even, and getting them to really understand what the product is doing. So I appreciate your take on that. And then to conclude, what I really wanted to kind of go over was just a few questions around your portfolio construction philosophy. How do you ultimately decide whether something adds true diversification to your client's portfolio versus simply adding complexity? It's definitely a question that I kind of have with my own portfolio.
Yeah, good question. And I can definitely relate to what you shared earlier, right? About um, maybe having too many positions, right? I've experienced that in the past, and it continues to be something to focus on, right? Having a high hurdle rate for adding something to your portfolio, and that's just really immensely even stronger, like with clients, right? Like you got to be very careful and intentional about what you do with client money. And so, for me, again, I try to keep things really simple as possible, unless the client wants to be very aggressive, is really asking for single stock positions. I try to avoid them. So, like that itself narrows us down to ETFs, right? And then, with equity portions, again, I'm going to stick usually to the index, or, at most a couple other ETFs that are still very diverse. Um, so, broadly speaking, if we're in something like, the Vanguard S&P ETF, short and intermediate term treasuries, which Vanguard also has ETFs for, gold, and maybe long term treasuries if we have a small allocation there. That itself can be the portfolio. I'll probably add, though, I might usually have a small cap exposure, something like Avantis, US small cap value. That is in a lot of portfolios I have. But from there, you know, any other product is going to have to increase our expected returns and or lower our volatility, right? And so, one way of looking at that is the Sharp. Um, but to me, it's got to do one or both of those. And if it is something that's adding diversity and reducing volatility, then that asset itself also has to have positive long-term returns.
Yeah, no, I like that. It's very simple, but it's also what matters the most, and it's easy for people, I think, to understand that as well, because you do get to a point like me where, yeah, you start realizing you probably have too many positions and too many companies that you like, and you need to scale down a little bit too, and really focus on what matters. So, just a few closing thoughts as you move toward portfolio management now. What matters most to you? Returns, drawdowns, diversification, being tax efficient, client psychology, which I know is important, or something else?
So it's a combination of that, right? Like ultimately with clients, what I want is to, aid them in living their best life and, enhance their financial standing as much as possible. And so that's a combination of returns, right, which are net of tax, you know, long term returns, and it's also kind of their confidence and psychology, right, regarding their financial situation. So it might surprise you, or maybe not, but it surprises me sometimes. I meet people who, let's say, have a $5 or $10 million net worth, and they're not comfortable financially. They're stressed out. They don't have peace about their allocations, right? Their portfolio, or like their long term, financial security. And so, being able to provide them that is often more important than the returns I'm getting for them, right? Whether it's 5% or 7% or 9% or more or less, right? It kind of doesn't matter as much as the fact that now this person feels confident in their financial plan and is living out the rest of their life with their grandkids and their spouse and pursuing their hobbies instead of watching CNBC all day and worrying about their portfolio. It's crazy. I mean, this happens. I'm talking about people in their 60s or 70s who, even if they did just sit in a high yield savings account, they'd be just fine. Or if they just sat in stocks, they'd be fine, but they're doing neither and they're not happy. So to me, that's like square one. And then square two is obviously enhancing their financial situation. So a lot of people aren't worth $6 million, right? And they're still trying to grow wealth, and they may or may not care about volatility. So we work within those boundaries, right? And sometimes that's just helping people understand what they own. Like, hey, we're just going to own the S&P and small caps maybe, and they can ask me about it. I can be there for them during drawdowns, and if they want to take advantage of any other opportunities, right, we can do that too. Um, and speaking of which, there's plenty of people in that situation who probably don't need an advisor, and I tell people that, like, hey, if this is all you want, you probably don't need me. You can just go and do this, and just keep buying this every year or every month, right? Um, but for most people, they have more things going on, whether it's a business or tax concerns, or they want to take a different approach, right? Um, or they want to manage volatility, right? So, kind of bringing us back to that topic, there are a lot of people, and I mean a lot, who are sitting in cash, sitting in a savings account, know that they should invest, but are afraid that when they buy the S&P, it's going to go down 30% over the next 6 months, right? Like, and they just don't want to experience that, even if they know that they'd recover from it. So, for that person, which is a lot more than we often think, helping them construct a portfolio, or constructing for them, right? A portfolio that reduces that volatility by maybe half and still gets them an expected 6, 7, 8, 9% return. That's amazing. And I never thought as an advisor that that's what I'd do for people. I thought I'd just like convince them to own stocks, right? But that's not what they need. They wouldn't do it. They wouldn't be happy with it. So, I'm trying to basically understand their constraints, their psychology, their boundaries, and then find them as much return as we can within those limits.
Yeah, I think that's great. And then, I mean, ultimately, over the long term, you should have more people investing in the market in general, which is just a good thing. I wanted to ask you if listeners could take one thing away or one core idea from the episode. We've talked about a lot. What would you want it to be?
I mean, I guess I would say, you know, to keep it simple, right? We see a lot of crazy portfolios and crazy investment ideas. I think a big part of what I do is just help people avoid mistakes as well. So, what I'd leave somebody with, if I had a quick elevator pitch style thing, is, keep it simple. Buy the S&P regularly and often. Don't sell it, assuming this is money you're comfortable investing. If you're not, it's okay to keep money in a high yield savings account, but you need to understand that you're losing maybe 1 to 3% a year, right? In addition to just not gaining any wealth, and that's going to hurt you in the long run. and you're really missing out on an opportunity to, build the wealth that you should be. If you're not comfortable with buying the S&P and you're in that situation, then I would really take note of some things we've discussed in this episode. Maybe even a single ETF like the State Street All Weather. The ticker on that is ALLW. And you could just buy that as a one-stop shop for, an all-weather portfolio, right? Um, but if you're not comfortable with that, then you'd either need to do it yourself and create a diverse portfolio of equities and bonds and maybe gold. And if you're interested in managed futures or commodities, then that too. Or I'd reach out to an advisor if you know one. If you don't, I think Michael will plug my stuff in here. You're more than welcome to reach out to me. I'm always happy to give free advice. I don't try to convert everyone into a client. And, I love helping people do this.
I love that. That's great advice. And for those listening, you can follow Blake X at DD Blake. That's Blake Fischer Fischer. Well, thanks again, Blake. I appreciate the time.
Yeah, thanks for having me on, Michael. This was great. And I'm a fan of the podcast, so enjoyed it.
And that was my conversation with Blake on building a portfolio you can actually stick with. Equities remain the primary growth engine for most portfolios, while bonds, gold, commodities, and alternative strategies can each play a role depending on the environment. The challenge isn't building the spreadsheet, it's living with the portfolio. Huge thanks to Blake for joining me for his first appearance on Stock Spotlight. I'll have his X account in the show notes. And if you enjoyed this episode, please follow the podcast, take the episode poll, and share it with someone interested in portfolio construction and long term investing. You can also check out my Substack for a written recap and additional resources. Until next time, keep your investment smart.